The Real Investment Show.
So welcome back to the show this morning. It is, of course, Thursday as we get ready to wrap up the week. Market's been trading very positively this week on this hope now that, and we've been talking about this for a while, this whole debt ceiling issue will get resolved. It'll be put behind us. It always gets resolved. Nobody wants to, potentially not raise the debt ceiling because they all want to spend money. We've talked about this. Both Biden and McCarthy came out and said, no, we will not default on our debt. And the market, sigh of relief, got a bit of a rally here. Yes, it'll get done, despite the fact that we keep getting all this stupidity in the media about defaulting on debt, etc. But it's interesting right now that the markets and the Fed still have 5% interest rates right now, and that's obviously an impact on the economy, tighter lending standards. And yet the market is trading very bullishly and expecting a no recession type scenario. Yet his history says, and again, if we have to go back, the only thing we can rely on is history, is that, when you have tighter lending standards and very high interest rates, that you're going to slow economic growth. I mean, that's what the Fed wants, right? They want slower economic growth to bring down inflation. Inflation is coming down, but it's still elevated relative to where they want it to be. And the path of the inflation reduction is certainly not on track with meeting the Fed's goals of 2% inflation anytime soon. So I thought it's interesting, if you take a look at most fund managers, this was from B of A, most fund managers think rate cuts will begin in the first half of next year. Now, that's been moved out a little bit now. Remember, we were talking earlier that if you take a look at the rate curve, they were expecting rate cuts to begin in the last half of this year. That's now been pushed out to the beginning of next year. But even with that, a big chunk of fund managers do think rate cuts will start in quarter 3 and quarter 4 of this year. And then the majority of them think it'll begin in the first quarter of 2024. So that's what the market's thinking, right? The Fed's going to start cutting rates soon, and that's going to be easier monetary policy. So lower rates, better for stocks, buy stocks now. That's the plan. But I thought it was interesting this week, and I wanted to get Mike's opinion on this. Several Fed officials came out during the week and made speeches. Barkin said inflation remains stubbornly high and isn't easing fast enough towards the 2% target. Jefferson said little progress has been made in curbing too high inflation, and this is what we've talked about. If you take a look at core inflation, it's not coming down. It's remaining pretty sticky. Bostic cast doubt on rate cuts this year, even if there is a recession. And Neil Kashkari, he's wrong about everything. Anyway, he says tight monetary policy may be needed for an extended time. Now, that language we've known for a while, so he's not really going out on a limb here. The Fed's been saying that the whole goal is to hold rates higher for longer. But, Mike, it's an interesting, to your point that you were making, in the last segment, is that, when we look at this idea of the markets, which are clearly trading bullishly, markets tend to lead the economy by 6 to 9 months, suggesting that the economy is going to be doing better. And again, when we take a look at a lot of the inflation data, when we take a look at the economic data, we've had very negative economic data for a very extended period of time here. And so just from the standpoint of even sentiment, right, these sentiment surveys, a lot of these are so negative that it won't take much to start getting positive surveys. Just, if you go from 0 cells to 1 cell, that's very positive, right? So,
right.
And so a lot of this data has now gotten so bad that, it's just by its very nature of the economic cycle, it's about to start to improve. The question is will it start to improve before we actually register a recession? But to your point that you were making, that, we still have these very high interest rates, and it certainly doesn't seem from Fed comments this week that they are in the mood to cut rates anytime soon, even though the market's expecting that sooner than later.
Right. So, but I think that's the bullish case. If you look at Fed funds futures, and I put a little more weight on that than all these surveys, because Fed fund futures is real money. People are putting real money into that. Anyone can answer a survey any way they want. But when you put money at risk, you have a stronger opinion in theory. So again, the market expects the Fed will cut rates 50 basis points this year, and then a total of 200 basis points by the end of 2024. That's the bullish case. The bullish case is that there is no recession, that we continue to grow at 2 to 3%, and that inflation comes back to 2%, and the Fed cuts rates down to, 3%, give or take a little. That's really what's driving bullish sentiment. And that argument makes sense, right? If the Fed's going to lower rates and inflation's going to get back to normal, then the Fed is going to stimulate the economy with lower rates. It's going to take away that headwind of lower rates. It's going to allow companies to refinance at lower rates. It's going to open up the mortgage market, open up the refi market a little bit, and that provides economic stimulus. The problem, as you said, Lance, is that the Fed is very concerned that inflation is sticky, and it is sticky, and there are reasons it's going to come down. But unfortunately, the reasons for it to come down are because of a slower economy. If the economy doesn't slow, it's going to remain sticky, at which point the Fed is going to keep rates where they're at, or maybe just reduce them slightly. But it's hard to see them really cutting rates when they don't have to, and when they're scared to death of inflation. We've talked about this before, that this is the first inflation outbreak we've really had since the 70s and 80s. And the big lesson that they learned in the 70s was don't give up the fight too early, because inflation tends to come in waves. You get a big jump, it goes all the way back to normal. The Fed takes their foot, they take their foot off the brakes, everything's cool, and inflation pops back up again. And I think they're scared to death of the 70s and 80s, and they quote Volcker enough that they certainly understand what happened then and the mistakes that were made during the 70s and what it finally took to squash inflation in the 80s. And I think we have a Fed that while everyone thinks they know what the Fed's going to do, the Fed is telling you day in and day out that that's probably not what they're going to do. And that's what makes this environment, both from an economic perspective, forecasting perspective, so hard, but from an investment perspective, very hard. The market's pricing in a kind of Goldilocks scenario, and the Fed's telling you don't bet on it. And, the market's often right, but the Fed ultimately is the one that controls liquidity. They control the money supply. They control, indirectly, they control the fate of the markets. So which one are you going to listen to? And unfortunately, we listen to both. Not unfortunately, but we listen to both. And we take their messages and we try to understand what they're thinking and what it would get to change. And right now, you got a big divergence in these views. And again, I think it comes down to employment. Let's just see how employment comes out over the next 3, 4, 5 months. We know jobless claims have been ticking higher. For the first time, they're actually higher now than they were in 2019 before the pandemic. They're still at a decently low level. It's not concerning, but the trend is increasing. We haven't seen it in the monthly BLS data, but we do see it in things like JOLTS. Job openings are quickly normalizing. The quits rate, so how many people quit their job to find another job, that rate has come down, and that's a sign of confidence in the labor force, that you're confident enough to quit your job because you know you could get another job and probably a higher paying job. So there are signs that the labor market is finally starting to normalize. Normalizing, though, isn't a bad thing. Normalizing is a good thing. What would become a bad thing is if the unemployment rate shoots higher, jobless claims shoot higher, and net a lot more people start getting laid off, which then affects confidence and consumption, and that's how you get into a typical recession. So, I think the market direction and economic forecasts are very heavily dependent on employment data for the next, probably through the summer, if not even into the fall.
And so that's going to be, again, this is going to be the big challenge between what the markets think and what actually happens in the economy. And this is what's going to make, the investing process so challenging, because at some point, it's easy to make a very bearish case in the markets, and you're good at that. Well, but it's part of this is also anticipating what the market's looking past, and are the markets starting to look past a lot of this stuff, saying, okay, the worst is priced in, and I need to get ahead of, the recovery. And look, nobody knows that answer. And that's the big challenge. And it's very easy to make a very bearish case, but yet the markets are trying to tell you something very different. And that's, trying to parse that out is the challenge, right?
Right. At the end of the day, just understand what everyone is saying. What are the bulls saying? Like, I spend probably more time reading the bullish case than the bearish case. The bearish case kind of makes a little more sense to me than the bullish case. Mm-hmm. But you have to understand a bullish case. And the bullish case is that the economy will be fine, unemployment won't rise too far, and the Fed's going to start cutting rates.
Yep.
And that certainly is very bullish. The Fed adding liquidity is bullish.
Yeah. It's going to be interesting to find out. The good news is that, like you said, Amazon is going to be announcing earnings here soon, and article out talking about, and I said this on the show, I said, I'm just waiting for Amazon Prime to become Amazon Pre-Prime, which is where I just think about it and it shows up. Well, Amazon is now focusing on this using artificial intelligence to speed up deliveries. Pre-Prime is coming. You won't even have to think about what you want. It's just going to show up on your credit card and at your door at the same time.
Oh, look at that. Awesome. I just got a cup of coffee.
There you go. Mike, thank you so much. All right. That wraps up the show for the day. Richard and Danny be here tomorrow for Financial Fitness Friday. And, of course, our latest article being on the website tomorrow. Our newsletter this weekend going through the earnings season update now. We've got about 94% of earnings in, so we can do a pretty good shot at actually evaluating what earnings on a reported basis look like. Were they as good as everybody thinks? It's in the newsletter this weekend. Be sure you're subscribed. Free delivery. Get right to your email inbox on Saturday morning. All right. Have a great day. We'll see you tomorrow. RealInvestmentAdvice.com.